In the summer of 1720, the richest people in Britain lost their minds. Members of Parliament, nobility, scientists, even Isaac Newton. They gambled everything on a company that had never made a profit, had no realistic business plan, and existed primarily to convert government debt into private wealth. Within 6 months, the scheme collapsed. Fortunes evaporated. Suicides followed. And the word bubble entered the financial lexicon as a permanent warning that somehow, 3 centuries later, we still refuse to heed. This is the story of the South Sea Bubble, the first modern financial crisis, the template for every speculative mania that followed, and a blueprint that's being replayed right now in markets you're invested in. The South Sea Company was founded in 1711 with a monopoly on trade with South America. There was just one problem. Spain controlled South America and had no intention of allowing British ships to trade freely. The company's entire business model was hypothetical. But that didn't matter because the real business wasn't trade. It was financial engineering. Here's how the con worked. Britain had accumulated massive debt from years of war. The government couldn't afford to pay it back. Enter the South Sea Company with a proposal. We'll assume your debt in exchange for shares in our company. Debt holders would convert their government bonds into South Sea stock. The government would pay the company interest on the debt. The company would use that interest to pay dividends to shareholders. Everyone wins. Except they don't. This wasn't innovation. It was a shell game. The company's value depended entirely on share price, not on profits from trade. And share price depended on confidence, not on fundamentals. As long as people believed the price would rise, it would rise. The moment doubt crept in, the entire structure would collapse. The scheme required one essential ingredient: hype. And the South Sea Company directors were masters of manufactured enthusiasm. They spread rumors of untold riches waiting in South America: gold, silver, endless natural resources. They bribed members of parliament and government officials with shares. They created an atmosphere where not investing seemed insane. The manipulation was systematic. Directors would buy shares, driving the price up. The rising price created demand. New investors piled in, driving the price higher. The company would issue more shares at the inflated price, pocketing the difference. Then directors would sell at the peak, while publicly encouraging others to buy. This wasn't market mechanics. It was orchestrated theft. By June 1720, South Sea shares had risen from £100 to over £1,000. Fortunes were made on paper in weeks. A coachman became rich enough to buy his own coach. Servants quit to become full-time speculators. The mania transcended class. Everyone from dukes to shopkeepers crowded into Exchange Alley, desperate to get in before it was too late. And that's when the ecosystem of fraud exploded. Seeing the South Sea success, hundreds of new companies launched, each more absurd than the last. One company promised to drain the Red Sea to recover treasures from the biblical Exodus. Another offered to manufacture a perpetual motion machine. One prospectus, now legendary, promised returns on a company for carrying out an undertaking of great advantage, but nobody to know what it is. That last company raised £2,000 in a single morning before the promoter disappeared, never to be seen again. It was the purest distillation of bubble psychology. Investors throwing money at literally nothing because they assumed someone else would pay more later. I want you to comment below. Which modern investment do you think most resembles the South Sea Bubble? SPACs? Meme stocks? Crypto projects with no utility? Because the mechanics haven't changed. Only the terminology. The collapse began in August. A few large investors started selling. The price dipped. Panic replaced euphoria almost instantly. Those who had bought on credit faced margin calls. Forced selling accelerated the decline. Within weeks, shares that had traded at £1,000 were worth 100 again. 90% of value evaporated. the human cost was staggering. Aristocrats who had mortgaged estates to buy shares faced ruin. Middle-class families lost life savings. The suicides that followed weren't recorded in official statistics, but contemporary accounts reference them repeatedly. Those who survived financially were destroyed socially. Being known as a South Sea investor became a mark of shame, evidence of greed and foolishness. The political reckoning was almost as severe. When Parliament investigated, they discovered that company directors had systematically bribed government officials with shares, creating a web of corruption that reached the highest levels of power. The Chancellor of the Exchequer was sent to the Tower of London. The Postmaster General fled the country. King George's mistresses were found to have received shares as bribes to influence the king. The investigation revealed something more disturbing than individual corruption. It exposed how financial innovation could be weaponized. The South Sea Company had pioneered techniques that would reappear in every subsequent crisis, using leverage to inflate prices, creating artificial scarcity, spreading false information, and most critically, timing sales to dump shares on unsuspecting buyers at the peak. Isaac Newton lost £20,000 in the bubble. That's roughly $4 million in today's money. When asked about it later, he said, "I can calculate the movement of stars, but not the madness of men." Even genius couldn't protect against mass delusion when it achieved critical velocity. Parliament's response was the Bubble Act of 1720, which prohibited the formation of joint stock companies without royal charter. It was meant to prevent future manias. It didn't work, because the Bubble Act targeted the symptom, not the disease. The disease was leverage, speculation, and the belief that asset prices could rise forever, independent of underlying value. That disease is incurable because it's rooted in human psychology, not market mechanics. The South Sea Bubble established patterns that echo through financial history with terrifying consistency. The 1929 crash, the dot-com bubble, the 2008 financial crisis. Each one followed the same trajectory. Innovation creates opportunity, leverage amplifies gains, euphoria replaces analysis. New investors flood in at the peak, early players exit, late arrivals are destroyed. The timeline compresses, but the mechanism remains identical. In 1720, the bubble lasted about 8 months from peak euphoria to collapse. In 2000, the dot-com bubble took 2 years. In 2008, the subprime crisis unfolded in 18 months. The digital age hasn't prevented bubbles. It's made them faster and more violent. Here's what makes the South Sea Bubble the foundational crisis. It proved that markets are not rational, that crowds are predictably irrational, that innovation is often a cover for fraud, and that government intervention after a crash is politically necessary but economically insufficient. Every element that makes modern markets fragile was present in Exchange Alley in 1720. Debt-fueled speculation. Assets priced far beyond any reasonable valuation. Investors who don't understand what they're buying. Insiders who time their exit perfectly. And a collective delusion that this time is different. The South Sea Company didn't fail because of bad luck or unforeseen circumstances. It failed because it was designed to fail. The entire structure required perpetual growth in share price to sustain itself. That's not a business model. It's a Ponzi scheme with better marketing. 300 years later, we're still building South Sea companies. We call them unicorns. We call them disruptive technologies. We call them the future. But strip away the modern language and you find the same architecture. Companies valued not on profits but on narrative. Leverage amplifying both gains and losses, and a game of musical chairs where the music inevitably stops. The ghost of Exchange Alley doesn't haunt history. It operates on Wall Street, in Silicon Valley, and cryptocurrency exchanges. Same greed, same delusion. Same devastation when reality reasserts itself. If this historical analysis changed how you see modern markets, subscribe. We don't just tell stories from the past. We show you how those patterns are playing out right now. And share this with someone who thinks this time is different, because it never is. The players change. The game remains the same.